Hey, Saretsky here. As always, Canadian real estate market update with a particular focus on Vancouver. If you get any sort of value or entertainment out of these videos, all I ask is that you hit thumbs up and subscribe. Questions, comments, put those below. I wanted to frame up this week's video because he's back again. Bank of Canada Governor Tiff Macklem with some recent comments on the state of the nation's housing market.
With respect to the housing market, what we get worried about is when we start to see extrapolative expectations, when we start to see, people expecting the kind of unsustainable price increases we've seen recently go on indefinitely, and they're basing their decisions on those kinds of assumptions. So when we see extrapolative expectations, when we see people starting to buy houses solely because they think the prices are going to go up, that is a warning sign for us. We are starting to see some early signs of excess exuberance, but we're a long way from where we were, say, in 2016, 2017, when things were really hot. And the other thing I would emphasize is that quite a lot has changed since then. Both federal and provincial governments have put in place new measures. I think federally, the B20 mortgage stress test has been very useful. Having said that, as I indicated, we're expecting the economy to strengthen going forward. We think there will be a need for considerable monetary policy support to generate a complete recovery. And in that low for long world, there are risks that housing could get carried away. So that is something we will be looking at very carefully, and we certainly will be updating through our financial hub, our monetary policy report, our financial system review.
This guy says we're starting to see signs of irrational or excessive exuberance. Again, I'm not sure which rear view window this guy is looking at, but he's 2 steps behind the market. And these central bankers are always 2 steps behind the market. If we look at what's happening in the national housing market, you right now have the home price index on a year-over-year basis. It's accelerating, showing a 12% year-over-year pace of growth. The highest that we've ever recorded is a 19% year-over-year growth in the early parts of 2017. I can almost guarantee you, because it's baked in the cake in the way that home price index model works, is that you will probably see home price growth accelerate above 19% probably by this summer. Regardless of what happens in the market, even if the market starts to stabilize and flatline from here, because of the way that home price index works on a lag, you'll probably still see that home price index accelerate probably towards new record high pace of growth. So you essentially have national home prices basically running at a 20% clip. And this guy says, well, we're starting to see some signs of excessive exuberance. But this is always the playbook. And the only thing that's going to stop this guy, remember, the Bank of Canada has already pledged no rate hikes until 2023, until the recovery is well underway. The only thing that is going to prevent or slow the housing market here is a pop of inflation and in inflation expectations. And when that is exactly what we're starting to see now. Again, all you have to do now is look at what's happening in the bond market. So we've all of a sudden started to see yields start to back up globally. We can look at, if you want to look at the one that impacts the Canadian housing market the most, look at the Canada 5-year bond. It's basically back up towards levels, pre-pandemic levels. So you've got yields starting to back up, and now we have mortgage rates as a result. Banks are starting to push their mortgage rates back up. So we've got the 5-year fixed has gone from about 1.5, 1.6, maybe 1.7. We're now seeing the typical 5-year fixed uninsured mortgage is around 2% now. So the banks are starting to push their mortgage rates up. And you can imagine what happens to a market that is extremely leveraged. Any sort of move up in interest in mortgage rates starts to immediately maybe not immediately, but it will start to impact the housing market as rate locks start to expire and as people start to go in through the renewal process, etc. So, for example, you can only imagine a scenario where the mortgage rate goes from 1.5%, which it was, up to say 3%, you'll have an immediate slowdown in the housing market. So keep in mind, we're very early stages here, much too soon to start, firing off the alarm bells. But what matters here is the markets smell, the markets are sniffing, the markets are saying inflation is here or inflation is coming. Global money supply is up double digits. I mean, I think the U.S. M2 money supply is up 26%. And just this past week, Jay Powell comes out, U.S. Federal Reserve Chair, and says, we need to unlearn everything that we know about modern economics. Just because we have money supply up 26% does not mean we'll get inflation. Well, the market, again, disagrees. All you have to do is look at a chart of commodities. Commodities are ripping up higher. We're seeing bond yields, again, start to back up. And this is why you're now seeing a repricing in the bond market, in the mortgage market, for example, as well. And so this is going to be something to continue to watch and continue to monitor. But as I've said before in all of my past videos over the past several months in particular, I just have a personal view. Again, my view could be right, it could be wrong. I have a personal view that the way that central banks are going to tolerate this, or the way that they're going to handle it, the way that policymakers will handle it, is probably not what you necessarily expect. And so consider this. We've talked about this numerous times, but you have globally, you have a global bond market with $18 trillion in negative yielding debt. So all of a sudden, if you start to get the rates pushing higher on that $18 trillion of negative yielding debt, it starts to create a problem where you basically create a solvency problem where all levels of society, public sector, the private sector, in terms of households and corporations, cannot service that debt. So you can't have rates even go from, where they are today. You can't have rates triple, let's say, for example. So basically you have three ways out of this. And there's three possible scenarios. So scenario one is policymakers, central banks, for example, they say, oh, wow, like the free market, the real market is pushing commodity prices up, it's pushing yields up. The real market says inflation. Let's just not do anything and let's let yields run. So, you get massive run up in yields across the board, and you're probably looking at all of a sudden everybody starts to suffer. They cannot pay their debts. Obviously, the housing market would immediately slow down, and so you'd be looking. You have an immediate repricing in global asset classes. Okay, real estate sells off, equities sell off. Things like Bitcoin, crypto, everything sells off. You're probably looking at Great Depression 2.0. So do I think policymakers are going to go that route? Highly unlikely. Can they control it by every aspect? No. But that's option number one. Just let the free market do its course. Yields throw up. You have this base boom, great reset. Everything collapses, and we cleanse a lot of the bad debt, and we start fresh. So but again, you're gonna have to go through some nasty pain, probably Great Depression 2.0, given the amount of leverage in the financial system. Option number two would be policymakers, central banks, governments alike. They come in with a form of yield curve control. And how they want to implement that yield curve control is, you could say the central banks just continue to soap up all this government debt. They'll buy every last single government bond in order to suppress the yields. That's possible. That's could be option number two. They could go the different route where the government can come out and say, hey, bank, hey, RBC, hey, pension fund, you must buy this government debt. If it starts to hit, let's say the Canada 5-year bond, if it hits 1.5%, you must buy. You have to buy. And they did that during World War II. Okay? So it's been done before. It's a form of yield curve control. So that's option number two. I think that's the most likely option because it's been done before. It's probably the most palpable. Yes, it erodes free markets, and unfortunately that is what it is. But it's probably better than scenario one. So that's probably the route they're going to go. Now, option three is, well, we don't want to let free markets, we don't necessarily want to intervene too much in free markets. Yes, we already own, close to 50% of the government bond market, but we're gonna stop there. We're not gonna intervene anymore, and we've hit our limit, and we're not gonna move the goalposts anymore. So let's let yields run up. Oh gosh, this is not looking good. Debt jubilee. That's option three, is debt jubilee. So you've got sort of one, let the free market do its thing and just have this boom, bang, great reset. Every asset class resets and free markets win out. Yay, yay, yay. Option number two is a version of yield curve control. You can debate how that will be implemented. And option three is a debt jubilee. Again, my personal view is option number two. And I'm not saying that just because they go option number two, you don't have some form of repricing. Now, keep in mind, my opinion is that option two, it will not be implemented right away. So, for example, what we're seeing right now in the bond market, they're not going to come in and step in right away. So everybody's sending me these links and these articles being like, hey, yeah, see, I told you inflation's here, yields are going to go up, housing's going to crash 40%. Oh my God, get out, sell the farm. I agree. I think yields are going up. Obviously, when you print the amount of money that you have, the market is going to have inflation scares. The central bank saying we're never raising rates till 2023 and beyond, blah, blah, blah. Of course you're going to have that scare. I just think that that scare, I think, is temporary. You're going to see yields push up. Again, maybe you see 5-year mortgages in Canada go from 1.5 to 2 right now to 2.5. Maybe they hit 3. But at some point, they're going to hit 3 and they're going to get, hold on, okay, enough's enough. The housing market starts to slow down. And keep in mind, I'm not just talking about Canada, because the Bank of Canada basically follows every other central bank. The Bank of Canada is just these little minions that follow what the Fed does and the ECB. The ECB Lagarde was out just this past week saying, already, it's all over the Financial Times, Lagarde coming out, making her press speeches. We're watching yields. This is not good. We're watching yields. If we need to intervene, we'll intervene. We're watching. So these guys are already there. They just don't want to flinch yet. They want to make it look like there's a free market and the dust will settle. And I think that we're at a very interesting inflection point. And so what happens next is I think that you could very well see a move up. You'll see assets sell off, and policymakers will be forced to intervene, whether you like it or not. I think that's the most likely scenario. I'd love to hear your thoughts. There's still a camp out there: inflation, deflation, financial repression, free markets. What do you think? As always, we're here every single week digesting these markets. See you next week.